So silver just jumped more than 4% today. As of right now on April 8th, it is trading at around $75 an ounce. And everybody is out there talking about the ceasefire. The US and Iran agreed to a 2-week window to work out a deal, the Strait of Hormuz opened back up, and silver bounced hard. And I get it. That is the headline. But I want to tell you right now, that is not the story. The ceasefire is not the story. Because the structural problems in the silver market that built up over the last several years do not care about a 2-week ceasefire. They were here before the Iran conflict started, and they're going to be here after it ends. And here is the thing that is driving me crazy right now. Silver is sitting at $75 today. But just a few months ago, in January of 2026, silver hit $121.64 per ounce. An all-time record. And it has pulled back about 37% since then. And I have seen so many people over the past few weeks saying, see, I told you silver was overpriced, the rally is dead, it was just hype. And I want to be very clear with everybody watching this right now. A 37% pullback does not fix a structural supply crisis. It does not put 820 million missing ounces of silver back in the ground. It does not unlock China's export restrictions. It does not rebuild a COMEX vault that has been emptied out to levels nobody has seen in years. The price going down while the fundamentals get worse is actually one of the most dangerous setups you can have in any market. So today we are going to talk about what is actually happening. Not the ceasefire. Not the price chart. The actual structural forces reshaping the silver market in a way we have not seen in a very long time. And by the end of this, you are going to understand why Bank of America is now putting out a silver price target range of $135 to $309. Why Citigroup is at $150 to $170. And why the former head of commodities at Goldman Sachs is describing what we are watching right now as the early stage of a supercycle. Now I want to talk about what happened today with the silver price specifically, because I think it is a perfect window into something most people do not understand about this market. Silver jumped more than 4% today because of a ceasefire announcement. And before that, since the Iran conflict started on February 28, silver had actually fallen 18%. That is a massive drop in a very short amount of time. The reason it fell is because oil prices went through the roof, which pushed inflation fears higher, which pushed expectations for the Fed to keep rates high, and silver hates high interest rates because silver does not pay you any interest. So money moved out of silver. People panic sold. The price dropped. But here is what nobody is talking about. While all of that was happening on the price chart, the physical silver market barely moved. Real buyers in Shanghai were still paying a 10% premium over Western spot prices. China's silver imports in just the first 2 months of 2026 hit 206.76 tons, the highest level in 8 years. Real demand for physical metal did not slow down while the futures price was getting hammered. And that gap between the paper price and what real buyers are actually paying in the physical market is telling you something very important. It is telling you that the futures market and the physical market are no longer telling the same story. And on top of that, silver is still up 143% compared to where it was a year ago. So anyone who owned it going into this year has had an extraordinary run even with the pullback. The people saying the rally is over are looking at a 37% pullback from a record high and calling it a collapse. But when you are up 143% year over year, a 37% correction is just the market taking a breath. Today also brought FOMC minutes from the Federal Reserve. The Fed is holding rates at 3.50% to 3.75%, and CME Group data shows a 0% probability of an April rate cut. 0. Which tells you the Fed is in no hurry to give silver the rate cut tailwind that would really send it. But the physical market is moving without the tailwind, which is actually the more interesting signal. So let me back up and explain where all of this started. Because this did not happen overnight. China controls between 60% and 70% of the world's refined silver supply. Let that sink in for a second. 60 to 70%. And on January 1st of 2026, China implemented new export restrictions that basically locked that supply down. They authorized only 44 companies, total, in the entire country, to export silver. Every other silver exporter in China, hundreds of smaller and mid-sized operations that had been supplying manufacturers and refineries around the world for years, suddenly had no legal pathway to ship metal out of the country. Gone overnight. and China called it a national security decision. Which is honestly one of the most honest things they could have said. Because that is exactly what it is. China looked at what they had, control over the majority of the world's refined silver supply, and they said this is a strategic asset and we are going to treat it like one. And when you control 60 to 70% of a material that the entire modern economy runs on and you stop letting that material leave your country freely, the effect on the rest of the world is immediate. Shanghai prices immediately jump to a premium of 10 to 13% above Western futures prices. And think about what that means in practice. In normal times, when Shanghai silver costs more than London or New York silver, traders just buy it in the cheap market, ship it to the expensive market, and pocket the difference. That is called arbitrage, and it is what keeps prices aligned globally. But you cannot ship what China will not let leave. So the arbitrage is broken. The spread just sits there, persistent, telling you that physical silver in Asia is genuinely scarcer than what the Western price is showing. It is not just Shanghai either. Retail buyers in Dubai were paying premiums of 40% above Western spot prices for physical silver coins and bars. In Japan, some secondary market platforms hit premiums of 60%. These are not made-up numbers. These are the prices real people were paying for real ounces of silver in the real world. And when the price somebody actually pays is 40% above the official price is not the real price anymore. Now let me explain what is happening to the vault that is supposed to back the entire Western paper silver market. Because this is where the numbers get really alarming. When you buy a silver futures contract on COMEX, you are buying a promise that you can get physical silver delivered at a specific price. The exchange holds what they call registered inventory, real metal in approved vaults specifically set aside to back those promises. For years, most buyers just rolled their contracts forward instead of asking for actual metal. So the system worked even with relatively low inventory levels. That assumption started breaking apart in a major way. In October of 2025, COMEX registered silver inventory was at 167 million ounces. By February of this year, it had crashed to 86.1 million ounces. That is a 31% drop in just a few months. At one point in a single day in February, the registered category lost more than 3.2 million ounces. In one day. The registered inventory is now sitting at a coverage ratio of just 13.4%. Which means for every dollar of physical silver that actually exists in those vaults, there are paper claims floating around worth about $7.40. That math works right up until the moment everyone tries to collect it once. In all of 2025, COMEX processed 474.4 million ounces of actual physical silver deliveries. That is more than double the 202.7 million ounces delivered in all of 2024. Every single month of 2025 deliveries were higher than the same month the year before. People are not rolling contracts anymore. They are taking the metal. And January of 2026, which is normally one of the quietest months on COMEX, recorded 49.4 million ounces delivered. In just the first week of January alone, 33.45 million ounces walked out of those vaults in 7 days. That is 26% of the entire registered inventory in 1 week. And the March 2026 futures contract had exposure of 528 million ounces. But there were only 113 million ounces of registered silver available to actually deliver. More than 4 times the deliverable supply concentrated in one contract month. Think about what that is like in everyday terms. Imagine a parking garage that sells 4 tickets for every single spot it has. Works great as long as not everyone shows up at the same time. But the moment people actually start showing up and wanting their spot, you have got a serious problem. Now let's talk about why the physical demand is so relentless. Because even if China opened its doors tomorrow and the COMEX rebuilt its vault, you still have an industrial demand story that does not go away. The global silver market has been in a deficit, meaning the world consumes more silver than it mines, for 6 straight years. From 2021 through 2025, the cumulative shortfall was about 820 million ounces. That is nearly a full year of global mine production. Just gone. And the Silver Institute is projecting a 7th consecutive deficit this year at about 67 million ounces. Physical investment demand is projected to rise 20% in 2026 to 227 million ounces, which would be the highest level in 3 years. And here is why the industrial demand is not going away. Every solar panel needs between 10 and 20 grams of silver. This year, the solar industry is on track to install a record 665 gigawatts of new capacity, consuming over 125 million ounces of silver from that one industry alone. You have EVs. You have AI data centers where every server and every chip uses silver contacts because silver is the best conductor of electricity on Earth and you literally cannot replace it without losing performance. You have nuclear power plants using silver alloys in reactor control rods. And I just saw a Stanford study from January of this year showing that a nanoscale silver coating may solve the cracking problem that has been holding back solid-state batteries for years. So add that to the list. Industrial buyers do not get to say silver is too expensive, we will pass this quarter. A solar manufacturer cannot ship panels without silver. An electronics company cannot build chips without silver. The demand is what economists call inelastic. The price going up does not make those buyers disappear. It just means they pay more. And every ounce they pay more for is an ounce somebody else does not get. Silver mine production is essentially flat despite prices being at historically high levels. Most new mining projects will not come online before 2027 at the earliest. And silver inventories on the Shanghai Futures Exchange have plunged to 715 tons, the lowest since July 2016 and an 86% collapse from the 2020 peak. There is no cavalry coming on the supply side anytime soon. Here is the part of the story that I think is the most underreported right now. And that is what the big institutions are actually doing with their money. There is a difference between owning silver and owning a promise that someone else is holding silver for you. And the sophisticated money is making a very clear distinction between those two things right now. The Sprott Physical Silver Trust, ticker PSLV, doubled its capital raise program from $1 billion to $2 billion in January of this year. At silver prices around $110 at the time, that $2 billion buys roughly 18 million ounces of real physical allocated silver. That 18 million ounces is approximately 16% of the entire COMEX registered inventory. One institution. One capital raise. Buying metal equal to 16% of what the entire paper market is supposed to be backed by. And at the same time, the largest silver ETF in the world, iShares Silver Trust, ticker SLV, which holds something like 350 million ounces of silver, has been seeing outflows. Money is moving out of SLV and into funds like PSLV. And if you understand how those two products work differently, that tells you everything. SLV runs on a complex structure involving authorized participants, custodians, sub-custodians, leasing arrangements, and something called unallocated metal. When everything is normal, it works fine. But when physical supply gets tight and lease rates spike, and right now silver lease rates have been running at 7% to 8%, which is exceptionally high, the ability to actually source metal to back the ETF gets questionable. PSLV just owns the bar. Simple. And right now simple is winning. Russia just announced a multi-year plan to accumulate $535 million worth of silver in its national reserves. That is the first major central bank in the modern era to openly add silver to its reserve assets. Not gold. Silver. And India, starting this month, April 2026, is moving away from London-based precious metals pricing benchmarks entirely. That is a massive structural shift in how bullion gets priced in one of the largest gold and silver markets on Earth. And former Goldman Sachs commodities chief Jeff Curry has described what we are watching right now as early-stage supercycle behavior. Sharp spikes, violent corrections, followed by repeated surges. Driven by supply constraints, de-dollarization, central bank buying, electrification demand, and persistent debt fears all hitting simultaneously. COMEX futures trading set a 6-year high by volume during the January surge and a record $208.5 billion by value in a single day. So the participation is there. The demand is there. The supply is not. Now look. I want to be straight with you because this channel is not about screaming the sky is falling every single video. Silver is at $75 today. It was at $121 a few months ago. It is down 37% from that peak. And some people got hurt in that pullback. That is real. But here is the context you need. A year ago, silver was around $30. So even at $75 today, anyone who held silver a year ago has more than doubled their money. The pullback from $121 to $75 happened because the Iran conflict pushed oil higher, which spooked the Federal That is a sentiment-driven move. The underlying structural story, the 820 million ounce deficit, the COMEX vault drain, the China export controls, none of that has improved. It has gotten worse. Reuters is projecting a 2026 average silver price of $79.50. Bank of America has a target range of $135 to $309. Citigroup is at $150 to $170. These are major institutional research desks, not YouTube channels. So what do you actually do? The first thing is to understand what you own if you already have silver exposure. A standard silver ETF and an allocated physical silver holding are not the same thing. One is a legal claim in a complex structure. The other is a bar of metal with your name on it. Know which one you have and know what you are actually getting. Second, do not make panic decisions based on a single day's price move in either direction. Silver jumping 4% today on ceasefire news is not the reason to rush in. Silver being down 37% from its high is not the reason to panic out. The structural story is what matters, and the structural story has not changed. Third, pay attention to the COMEX inventory numbers. They are public and update every day. The paper leverage ratio is still 7.4 times the real metal in those vaults. That number going down means the system is healing. That number going up means the stress is getting worse. That single data point will tell you more about where this is headed than any analyst price target. Because at the end of the day, this whole story comes down to one thing. There is less real silver than the paper market pretends there is. And the history of commodity markets tells us that gap does not stay open forever. When it closes fast. Subscribe right now so you do not miss the follow-up on this. Drop a comment below and tell me whether you are holding physical, paper, or nothing at all. And check out the video on screen right now if you want the bigger picture on where this economy is headed. I will see you in the next one.